With Strategas in New York City, and I have the distinct honor of getting the conference started today as the chair of GIC, the Global Interdependence Center, which is a Philadelphia-based nonprofit organization that seeks to stimulate global dialogue on issues that affect the international community. It does domestic and international programming to provide a neutral forum for the exchange of thoughts and information. So we're not here to advocate, but to educate, to discuss, and that's why we love having partners like we have here today. And we are very excited to continue our central banking series and to take the conversation about the global economy into this forum. I'd like to thank our sponsors, Egan-Jones and Raymond James. And if you'd like to learn more about GIC, look to interdependence.org, O-R-G, to find out about upcoming programs in Europe and elsewhere. So we're in a wonderful space, and I'd like to get the conference started. Thank you.
Thank you very much, Donald, not only for the kind introduction, but also for being one of the pillars of this very conference. I'll have the pleasure to wish you welcome in my capacity as a president of SUERF. I would also like to thank very much the Bundesbank for their renewed assistance in organizing a conference jointly with SUERF and in this case with GIC. I'm happy that, Donald, that you went first, because as we say in Switzerland, the early bird catches the worm, but the second mouse eats the cheese. The cheese may be a bit poisoned in this case, though, because the only assignment I got here is a bit a tricky one. I have to introduce the next speaker, and this is difficult for me. I had to introduce, I think it was 2 years ago, you may remember, I had to introduce a person called Mario Draghi, and I introduced him as a governor of the ECB. Afterwards, our next speaker of today kindly called my attention to the fact that Mr. Draghi was not a governor. His colleagues were governors. He was president of the ECB. I went to Mr. Draghi and said, I apologize, I'm a cow Swiss. I have no idea about economic matters. He said, don't worry, this is the least of all the insults I have to hear every day. So I prepared for today, and I look at the written program, and what I find is Jens Weidmann, President, Deutsche Bundesbank. Now, I'm completely lost. Maybe we should go a step towards communism and call our speakers Comrade Weidmann. So I cannot make any future mistake. I do not have to introduce President or Governor Weidmann, and I do not want to spend your valuable time and all of your valuable time and invite you to the floor as soon as possible. Thank you very much.
Thank you very much for that kind introduction, dear comrades, dear colleagues, dear guests, ladies and gentlemen. Alfred Nobel once said, one can state without exaggeration that the observation of and the search for similarities and differences are the basis of all human knowledge. A conference that discusses monetary and economic policies on both sides of the Atlantic naturally takes that perspective of seeking out similarities and differences. This, together with the impressive cast of eminent academics, policymakers, governors, presidents, and financial market participants assembled today further strengthens my belief that this conference is a true font of knowledge, and it is therefore a great pleasure to have you all here at the Bundesbank's regional headquarters in Frankfurt. In my remarks today, I will try to take Nobel's wisdom to heart as well, what can be learned by discerning the similarities and the differences in monetary policy on either side of the Atlantic. Specifically, what insights does the American experience provide for the European Monetary Union, and what idiosyncrasies of the euro area might require it to chart its own course? To me, the comparison might prove instructive with regard to three dimensions in particular. First, the US is further along in its business cycle and therefore its monetary policy cycle than the euro area. But while this is a difference, it may actually allow us to look out for possible similarities. Similarities in terms of the appropriate point in time to normalize monetary policy. Second, the institutional setups of the US and European currency areas differ. The Federal Reserve System is the central bank of one country with only one central government, and in the European Monetary Union, a common monetary policy is combined with 19 different national fiscal and economic policies. And this institutional difference makes for a difference in the cost-benefit analysis of the policy options. Third, the euro area economy is more heterogeneous than the US economy, and this makes the job of the euro system much more complicated. And are there lessons to be learned from the US that would allow for a more even economic development in the euro area? And I'm confident that the answer is yes, but it might not be the answer that would readily suggest itself. But let me start by looking at the current economic developments in the euro area. The euro area has so far enjoyed 4.5 years of continuous economic growth. And as Mario Draghi pointed out recently, what started out as a recovery is now a fully fledged expansion. It is robust, it is broad-based, with most countries and sectors posting positive growth figures. As a result, the euro area grew even faster than the US economy last year, and after years of challenges, the euro area is now driving global growth and not dragging it down. Indicators show no sign of growth abating anytime soon. In many respects, the euro area economy might be further along the cycle now than the US economy at the time the Fed ended its net asset purchases. The euro area output gap of 0.5% for 2017, as estimated by the OECD, is considerably smaller than US output gap of 2.5% in October 2014. And at that time, the OECD believed the output gap to be even higher at 3.1%. And this suggests that the euro area economy might utilize its resources more fully now than the US economy did when the Fed ceased its net asset purchases. Inflation, however, has not kept pace with economic expansion. Domestic price pressures, measured by core inflation, excluding energy and unprocessed food, stands at 1.2% in the euro area today. By contrast, when the Fed ceased its net asset purchases, US core inflation was 1.8%. So what is behind the sluggish price developments? Multiple factors seem to be at play here. The euro area recovery has certainly been aided by countries strengthening their competitiveness and turning their current account deficits into surpluses. But improving price competitiveness through wage restraint is, naturally enough, also dampening domestic price pressures. In parts of the euro area, migration from EU member states not participating in the euro might have played a role as well. In Germany, for example, migration from the non-euro area member states has eased labor market tensions, and this has dampened wage pressures and, in turn, inflation dynamics. But the euro area is by no means unique in having an inflation rate that is lower than indicators of economic slack suggest. It seems to be a rather widespread phenomenon characteristic of the current situation in the US, the UK, Japan, and Sweden, for example. In the US, unemployment is the lowest it has been since the year 2000, but core inflation stands at 1.8%, and the Fed's preferred measure of inflation, the index of personal consumption expenditure, stands at only 1.5%. This suggests that the factors responsible for holding back wage growth are not only idiosyncratic, but international as well. Recent research by the Bank for International Settlements, for example, suggests that the increased contestability of labor markets via the proliferation of global value chains puts a lid on wages and thus, of course, also on prices. Given the rather subdued inflationary pressure at present, an accommodative monetary policy stance remains appropriate in the euro area. And even, by the way, after the net purchases have ended, the monetary policy stance will remain rather loose. However, the favorable economic outlook lends credence to the expectation that wage growth and therefore also domestic price pressures will gradually increase in keeping with the path towards the Governing Council's definition of price stability. The recent pay agreement in the metalworking and electrical engineering industries in Germany is consistent with this picture. Not only is it in keeping with the expectations we based our forecasts on, in my opinion, it also demonstrates that the Phillips curve does by all means have informative value, at least where Germany is concerned. To cut a long story short, if the expansion progresses as currently expected, substantial net purchases beyond the announced amounts do not seem to be required. The recent appreciation of the euro seems unlikely to jeopardize the expansion, by the way. In fact, it is at least in part rather a reaction to the brighter growth prospects of the euro area, and besides, recent research suggests that the exchange rate pass-through, which is to say the impact of exchange rate movements on inflation, has declined, but of course we'll monitor closely any impact of foreign exchange movements on our primary target. Nor, by the way, should we allow ourselves to become unsettled by the recent decline in equity prices. US equity prices rose over a prolonged period without any notable corrections, which was unusual given that valuations have already been quite high overall. Large-scale purchases of sovereign bonds are not the only unconventional monetary policy tool used. Communication in general and forward guidance in particular is now a policy tool in itself, geared towards the evolution of long-term rates. In this regard, BIS Chief Economist Yun Shin recently recommended central banks that when trying to shape rates through communication, they should avoid reading too much into the development of market rates. Otherwise, and I quote, they could find themselves in an echo chamber of their own making, acting on market signals that are echoes of their own pronouncements. If central banks are to use communication as a policy tool, they must not shy away from the necessary guidance for fear of market backlash. Otherwise, communication can become circular. He thus added, the more the central bank whispers in order not to upset markets, the more market participants lean in to hear better. Ladies and gentlemen, while communicative independence is indeed important, it's not the only form of independence crucial for monetary policy, especially for a monetary policy combined with 19 different national economic and fiscal policies. When the ECB presented its OMT program geared towards eliminating redomination risk in the euro area, commentators like Paul Krugman applauded the decision, stating that by acting in effect as a lender of last resort to governments, the ECB is finally doing its job as a central bank. The decision on the PSPP, the Eurosystem's large-scale purchases of sovereign debt, has been met with a similar approval. Nevertheless, some in the euro area have also been skeptical of sovereign bond purchases, and as you might have heard, I would count myself as one of them. Are the skeptics exaggerating the risks involved? Are they perhaps victims of what Freud has called the narcissism of small differences, seeing differences for the sake of being different? Or are the differences indeed substantial with regard to our capability to fulfill our primary target to maintain price stability? And I would argue, yes, they are substantial. Government bond purchases by central banks involve the fundamental risk of mutualizing sovereign liability through the central bank's balance sheets. And while this risk can be safely ignored for countries with their own currency, it can be a major problem for a monetary union, especially for one like the European Monetary Union, which is not a fiscal union. At the end of the day, it could introduce common liability for sovereign debt through the back door, and in this regard, it's up to elected governments and parliaments to make such far-reaching decisions. In contrast to the OMT program, the large-scale sovereign bond purchases currently being conducted take into account some of these concerns. Only a small part of the program is subject to risk-sharing among the central banks of the Eurosystem. And additionally, the Governing Council decided on limits for the Eurosystem's purchases of individual bond issues and for its overall purchases of debt of any individual country. And this is designed to ensure that governments continue to rely on the capital markets for their funding. And these measures make the QE program less problematic than earlier sovereign bond purchase programs that aim to reduce the risk premiums of individual countries. Nonetheless, one important risk of sovereign bond purchases remains. The national central banks have become the most important creditors to their governments, which might ultimately put the independence of monetary policy at risk. Exiting its ultra-loose monetary policy would influence governments' financing conditions much more directly than through our conventional monetary policy instruments. And the pressure might rise on the Eurosystem to keep funding costs low in order to ensure sustainability of public finances. If one adjusts the recent deficit figures for the currently very favorable business conditions, one cannot fail but see that consolidation has in effect stalled in the euro area member states. The European Commission expects practically no improvement in the structural balance this year and next year. In the European Monetary Union, however, fiscal discipline is absolutely essential. The setup of the monetary union can further compound the tendency of governments to finance their spending through debt, as the consequences of bad policy choices can much more easily be externalized to neighboring countries. Ladies and gentlemen, when comparing US and European monetary policy, the institutional setup is not the only difference that springs to mind. In the euro area, monetary policy is complicated by a much higher degree of heterogeneity compared to the US. Let's take unemployment. In the euro area, the weighted standard deviation of member states' unemployment rates from 2009 to 2017 is 5.7 percentage points. In the US, the weighted standard deviation is only 1.2 percentage points for the same period, and the result does not differ much if you consider different periods. A common monetary policy in a currency union means that one size has to fit all. The greater the differences, the greater the heterogeneity, the less well it will fit the respective member states. And this reduces overall economic welfare. But how then is the question, can this heterogeneity be lowered? Macroprudential policies are, of course, one policy option. They can be deployed against regional or sectoral pockets of exuberance in case they are expected to pose a systemic risk. Possible instruments include high risk weights for certain asset classes or loan-to-value ratios that raise equity requirements for a mortgage. Some euro area countries have indeed taken macroprudential measures to counter a strong increase in mortgage loans, fueling the ongoing rise in housing prices. And preventing certain sectors or regions from running hot will, of course, help to reduce overall economic volatility as well. First and foremost, however, national economic and fiscal policies need to be tailored adequately to ensure that economic developments do not diverge too much. Countries experiencing a cyclical boom should run a tighter fiscal policy, and countries experiencing a slump should loosen it. But for this to happen, countries need the requisite fiscal space, and this is why it's so imperative to adhere to the fiscal rules over the cycle in the euro area. Structurally, flexible labor markets are another prerequisite of a well-functioning monetary union. The higher the labor mobility within And across member states, the better fit a common monetary policy will be. Robert Mundell was awarded the Nobel Prize for this insight, aptly enough, by the way, on the occasion of the launch of European Monetary Union in 1999. In his first theory of optimum currency areas, he emphasized the necessity of capital and labor mobility. And economists like Peter Cannon later expanded on his work. In particular, they stressed the importance of risk sharing via fiscal and other means for a currency union to work smoothly. And it is here, in my opinion, that the differences between the United States and the euro area are instructive as well. In the United States, shocks are spread through the distribution of business profits and losses throughout the currency area because company owners are often residents in other member states. Another channel of private risk sharing is through saving and lending, and enterprises and households take out loans in different US states during an economic downturn to bridge slumps in earning. Risk sharing through fiscal policy, by the way, takes a backseat. By comparison, only 10 to 25% of risks are shared by a common fiscal policies and federations like the US or Canada. It is private means of risk sharing that bring the overall risk sharing level to about 80% in these currency areas. So it's important to note that by the way, just as a side remark, that the rainy day funds in place in many US states do not constitute a fiscal risk-sharing scheme between the individual states either. Many US states are strictly forbidden to incur debt. Thus, they set budget surpluses aside in a rainy day fund to be used during an economic downturn, and every state is using only its own funds. In the euro area, the fiscal rules permit individual member states with sound public finances to take effective fiscal measures against cyclical downturns or crises without breaching the fiscal rules or having to resort to outside assistance. And this makes the potential benefits of a rainy day fund here much less relevant. So clearly much could be achieved in the euro area by strengthening cross-border equity funding. To tear down the walls in European capital markets by standardizing national insolvency regimes is, in my view, just one particular important step. Investors need to be able to count on a level playing field existing throughout Europe. Not only would that promote private risk sharing, it would also reduce capital flows to less productive businesses and stimulate flows to more productive ones. And that would boost economic momentum, as OECD research has recently pointed out. So this is a pet project of François and myself, so I'm pretty sure that François will dwell on this much more in his intervention. I mentioned earlier that another way in which risk could be potentially be shared might be for enterprises and households to take out cross-border loans in times of crisis. Yet, this mechanism hardly worked at all during the crisis in the euro area. One of the steps taken in Europe to prevent the repetition of a financial crisis was to create the banking union, with its single supervisory mechanism and rules on bailing in creditors in the event of bank failures. The banking union bolsters the banking sector's resilience. This makes a loss of confidence in national banking systems less likely, and less danger of a fragmented financial system stabilizes lending, particularly, of course, in turbulent times. A common European deposit guarantee scheme could, in theory, even heighten this confidence. However, as with any insurance, one would have to make sure, in this case too, that the insurance does not cover losses which have already occurred, like bad loans already on banks' books. And that the insurance, of course, does not encourage careless behavior in the future. Unlike banks in the United States, banks in the euro area have a sizable share of sovereign bonds on their books. And to insure euro area bank risks in such a situation would, of course, be tantamount to insure fiscal risks. Given that the member states themselves still decide freely and independently on the level of government expenditure and taxes, this ultimately would set the wrong incentives. Finance ministers would see less a need to pay adequate attention to the sustainability of public finances. So one precondition for a European deposit insurance scheme then is that the size of government bond portfolios that banks hold on their books is limited. Doing away with the concentration risk of sovereign bonds in banks' books would be a boon to monetary policy as well. During the crisis, monetary policy transmission was hampered by these large and undiversified sovereign bond portfolios. Potential losses on these portfolios were draining banks' equity buffers. The banks in question were therefore unwilling to lend and to pass on the low policy rates to companies and households. In order to shield an economy from a sovereign in trouble, banks must be restrained in taking on government debt. Ladies and gentlemen, Alfred Nobel never envisaged a Nobel Prize for economics. On the contrary, he once wrote in a letter that he did not have an economic education and that he hated it with all his heart. No wonder economics is dubbed the dismal science. Obviously, as you can imagine, I do not share Nobel's sentiment. On the contrary, I'm firmly convinced that a social science that is based on transparent assumptions and thoroughly steeped in data is of immense benefit to all of us. But I'm equally convinced that a conference like today's that sets out to discern similarities and differences would have met with approval even in the strict eyes of Alfred Nobel. So thank you very much for your attention. Looking forward to the conference, and it's great to have you all here.
Rob? Okay. Pick your seat. So we're moving right into the US view on monetary policy. My name is Emanuel Mönch. I'm heading the Bundesbank's research group. Before moving to the Bundesbank, I was a research economist at the Federal Reserve Bank of New York. So it's a great pleasure and honor for me today to be leading this interview with Robert Kaplan. Rob is the 13th president and CEO of the Dallas Fed, a role which he assumed in September 2015. Before joining the Dallas Fed, he was professor of management practice and senior associate dean at Harvard Business School. And before joining Harvard, he was vice chairman of Goldman Sachs with global responsibility for the investment banking and investment management division. So Rob's someone who's been following financial markets throughout his career, and we're going to be curious to hear his views on market developments in recent days. But before we get there, let's talk a little bit about the real economy.
Okay,
Rob, how strong is the US economy? We've seen a good labor market report. What's your views?
2018 will be a strong year in the United States. Our Dallas Fed forecast is for GDP growth somewhere between 2.5% and 2.75%. And there's several reasons it's going to be strong consumer sector. The household sector in the United States has spent the last 8 or 9 years deleveraging. It's been a long grind, but household balance sheets are in historically good shape. Job market is strong. Consumer in the United States is about 70% of the economy. And so that's a very significant, and we expect business spending to be stronger. Based on that forecast, we think we're already at or near full employment in the US, and we would expect headline unemployment to dip below 4% during this year into the 3s. So we will overshoot full employment, and we'll make some progress. We believe the cyclical forces on inflation will build, but we'll talk more about, I think, the structural headwinds of technology-enabled disruption will create some muting effect. So we'll make progress, but it may be slower than people think. Okay. One last comment. Mm-hmm. The out-year growth forecast, though, for 19 and 20 will moderate lower. So 2018, our forecast is stronger. Less strong in 19, less strong in 20. Why? I'll just quickly say 3 factors. Aging demographics, which I know it's common in many countries in the Euro area, mean slowing workforce growth, aging demographics. This is a continuing trend. It is going to intensify over the next 10 years. I would argue in the United States, we suffer from, we're lag in terms of educational attainment and skill levels. And I think that's having some effect in our judgment at the Dallas Fed on productivity, workforce-wide, even though companies are much more productive. This is accentuated by technology-enabled disruption. And the last comment I would make is we already have, the consumer's deleveraged, but the government sector is much more leveraged today than it was 10 years ago. And our concern is with 49 trillion of unfunded entitlements, and government debt to GDP rising, whether this in the out years will have some headwind effect on future GDP growth. We can talk about that.
So these are longer-term issues or factors. What do you think are the near-term risks to growth in the U.S.? And then we'll talk about structural issues.
When I talk about, so there's the cyclical and the structural. And remember, I'm not a PhD economist. I'm a business person. So the structural drivers, as a business person, I tend to weight them very heavily. I actually think the near-term worries and the medium-term worries are these big structural drivers. And I think we're starting to see the effects of them now. For example, the labor participation rate in the United States was 66% approximately 10 years ago. It's a little less than 63% today. We have a very tight labor market, but I think even to keep that constant will be a good accomplishment. And our own judgment is over the next 10 years, you could see that participation rate slipping to 61%. So if GDP is the sum of growth in the labor force and growth in productivity, I think both those have some challenges that we need to be dealing with now, and we can't put it off because it will affect growth in the U.S. soon. And for my money, 3 years from now is pretty near term, even though 2018 we believe will be a strong year.
So in light of that, what do you think is the effect, near term and longer term, of the recent tax reform that we've seen in the U.S.?
So one element of the tax reform was corporate tax reform. Lowering tax rates, incentives for investment. I've been a believer for a number of years that corporate tax reform in and of itself could have a positive impact on sustainable GDP growth if it incentivizes businesses to locate in the United States and invest. That's, though, only a part of this legislation. There's the second part, which was a tax cut, which is likely funded by increase in debt to GDP at a time where I believe debt to GDP at the government level is already at very high levels, and questions how sustainable that is. And I think that second part is more cautionary, but I think the effect of it is short-term bump. So our GDP forecast for 18 is a little bit higher by a few tenths than it would have been, but we think that effect will moderate in 19 and 20 and will head back down to trend growth, which we think is closer to 1 3/4 or 2%. And I think while the economy is strong, we need to be taking action now away from monetary policy to deal with structural reforms that get at these drivers.
So what are some of the structural reforms that you think should be implemented?
So I'll take them in pieces. And the reason, by the way, you may say, what are you as a central banker talking about these things? I think our job, and I believe my job as a central banker, because we do this analysis in an apolitical way, share it with policymakers, regardless of their political affiliation, appointed or elected. We think we've got to call these out because it makes it more likely we'll take action. So what's some of the reforms? On growing the workforce, we've already had women join the workforce in the United States over the number of years, and that's plateaued. I know in Germany, for example, that's been a recent improvement. We think that incentives for people to work longer, we need to look at. In addition, while it's a sensitive issue, there's no getting around immigration, and looking at immigration is something we need to look at and come to grips with. 50% of the workforce growth, by our analysis at the Dallas Fed, 50% of the workforce growth in the last 20 years in the United States has been immigrants and their children. We think that percentage is likely to be higher. I think we've got to deal and face how we want to handle immigration. On the productivity side, I mentioned technology-enabled disruption. Technology replacing people, consumers having much more pricing power using technology. which is incentivizing businesses to further invest in technology to replace people and to merge and to get scale. The point is, businesses have less pricing power than they have at any time in my career. The impact of this is muting on inflation, but the impact on the workforce, we have 46 million approximately workers in the United States with a high school or less education. And I think in the next 5 years, those people are likely to see their jobs either restructured or eliminated, many of them. And unless they get retrained, their productivity will decline. So what do we need to do the hard job of improving math, reading, science skills in the United States. This is not a short-term fix. It has to be done it has to be a national priority, in my opinion. And in addition, we need to dramatically beef up middle skills training, like has been done in a number of countries, Europe, Germany being the best example. We need to beef that up and talk to our young people. I used to be a professor, and get them ready for the idea they're going to have to get trained and retrained more during their career. And then the last part is, normally I'd say when things are good, we should be looking at entitlements and government debt and taking opportunities to moderate their growth. And my concern is maybe recent actions have not done that, and so I think we should take this opportunity to look for ways to moderate debt growth in the United States.
What do you think can the Fed do other than raising the awareness, talking to policymakers? Is there educating the public?
I mean, obviously we have to make sound monetary policy decisions. It's one reason these structural drivers is one reason while I am an advocate and have been an advocate for removing accommodation in a gradual and patient way, I've also said that the neutral rate, the natural rate, may well be lower than we're accustomed to historically. And I think these structural drivers, so it'll affect monetary policy, but the other part of our job is I just said, is I think it is our job to call these, do research on this, call it out, share it with policymakers, and I think we do a great service to do that. Last comment I'd make is last thing we can do, which especially for Dallas Fed is important. Texas is the largest exporting state in the United States. I think it's important we tease out the impact of technology-enabled disruption and the impacts of globalization. They're being confused today. And what do I mean by that? 15 years ago in the United States, if your job was lost or your company was disrupted or your industry was, it might have well been due to globalization. Today, not so much. More likely today, it's due to technology-enabled disruption. And in the US, it may be being attributed today to globalization. I think globalization today is an opportunity for us to grow faster. Integrating more with the rest of the world is an opportunity. I think the narrative has been confused somewhat with technology-enabled disruption, and I think part of my job is to separate those two and explain it so we have a better chance to make good policy decisions. The trading relationship with Mexico would be an example, where 70% of the imports to the United States today from Mexico are intermediate goods, not final goods, intermediate, which are integrated supply chains and logistics, which President Weidmann was talking about. Those help U.S. competitiveness, in our view, make North America more competitive and add jobs. And while that agreement needs to be modernized, I don't think it's a threat, that trading relationship to the United States. I think it's an opportunity, and we need to diagnose this accurately.
Since the US is such an interconnected country, it depends a lot on global growth.
Yeah.
What do you see, or where do you see the global economy, and what do you see as the greatest near-term risks to global growth?
So on the positive side, global growth has surprised to the upside, and it's better than we had expected. I think a couple of the issues. I guess I'll start with China, which I'm very aware that even though their GDP is showing approximately 6.5%, a little bit more. I used to live in Asia and run a business in Asia for many years. One of the reasons it's at that level is increases in debt to GDP. It's unlikely to be sustainable. I think it's probably manageable, but it's something probably the transition to more private economy, less reliance on spending on infrastructure, state-owned enterprises, and letting their GDP get to a more natural level. Probably the world has to get accustomed to probably lower levels of future growth from China. That would be one. The other challenge, I think, is this issue of globalization. While it's very true, maybe policymakers around the world have not done a good job cushioning some of the negative aspects of globalization. I think today, globalization, again, is an opportunity, and to the extent we integrate more as a world, I think we can grow faster. To the extent we pull away to different corners, my concern, that would be a threat, I believe, which could impede global growth.
The dollar has been somewhat weak in recent months. What do you think is what are the most important drivers behind the dollar's weakness, especially vis-a-vis the euro?
So if there's one thing I learned in my career, which I learned not to speculate about, it's the direction of gold and the direction of currencies. It's challenging. I mean, I do believe growth outside the U.S. has been stronger, as I said, than expected. I think that's been a factor. And so that may be one of the factors. So we'll have to see how it unfolds. My guess is, given the strength of the move in the dollar, you may see some moderation, and maybe we're already starting to see some moderation here. So we'll have to see how that unfolds. I think I also am concerned about the fiscal situation, debt to GDP in the United States, and projections of fiscal situation, and combine that with aging demographics. And it's possible that it will also have some effect on relative currencies, given different demographic situations, because they go together. As you age, you have fewer workers to service the debt, more dependence, and I think the mix between countries may be having some effect on currencies, I would guess.
To what extent does the Fed take into account these global developments in formulating its monetary policy?
And I've said many times, if you want to be a central banker in the United States, you've got it is not an option, but to think globally. You must think globally. We have to understand the interconnections and spillovers between what's going on outside the United States to the United States and vice versa. And in addition, if you look at the S&P today, in excess, depending on what time period, in excess of 50% of revenues and profits today of the S&P 500 are coming from outside the United States. So we're much more globally interconnected in our companies and our economies. Logistics, supply chain arrangements, in addition, financial flows are much more globally interconnected. So we've got to understand that and be aware of it in making policy for the United States.
Moving to U.S. monetary policy, the December survey of economic projections showed that the medium or central tendency had participants think 2 to 4 rate hikes might be in the books for 2018. What's your views on that?
So I've been saying my own base case is 3. And I think I call it a base case because it's not a static estimate. We'll update this, the summary of economic projections. We update every 3 months. Our next update will be in March. But I still believe that it is the right plan for us to be removing accommodation in a gradual, patient, but deliberate manner. And that would be my base case right now.
And so the recent last Friday's labor market report, which saw decent job growth, low unemployment, and maybe finally also some more sizable wage growth, didn't change your assessment?
It's consistent with my assessment, where I think 2018 will be a strong year of growth. I mentioned I think we're going to have further tightening in an already tight labor market. I think that should create some wage pressure. The only caveat would be, I think the transmittal mechanism in the United States, at least from wages to prices, is more muted because of this lack of pricing power by businesses due to technology-enabled disruption. So while I think we'll make progress on inflation, it may be slower and more uneven and more gradual than people expect. But I also think about the recent, you're probably going to ask me about the recent, what's going on in the financial markets and the stock market. I do think the last period, as has been mentioned, of 15 months, that was more the anomaly, at least in my career. I spent my career in the markets. I'm used to more volatility, having some corrections, I think that can be healthy. My concern, we've had an extended period of accommodative monetary policy in the world, but certainly in the United States, and monetary accommodation is not free. It can cause excesses and imbalances and distortions, and I've found in my experience they're a lot easier to recognize in hindsight than in foresight. They're easy to recognize in hindsight, and I think we have to be aware. Some of them may well be going on in the non-bank financial sector, and they're less apparent. And so I try to make about 30, 35 calls every month to CEOs, market participants. We do surveys. I think some of the imbalances and excesses might be buried and less visible. And so I think some period of a little higher volatility, maybe market adjustment could even be healthy. So we don't let distortions and excesses build to an undue extent.
So the VIX scratched at 50 last week, or earlier this week, I should say, the highest level since 2009. Now it's down to about 25, but still quite a bit higher than in recent months. So you're not worried that the recent volatility would sort of hamper the normalization process?
Well, so let me just say what I'm looking for and what I'll be very vigilant, and part of my job is to be vigilant. What I'm looking for is market correction or volatility in and of itself. It may not cause me to change my views, but does it transmit into tighter financial conditions? I'll be watching for that. And the real economy. So far, for example, I'm looking very closely the last week at credit spreads, and I've noticed, by and large, they're holding in pretty well. I'm so far not seeing it transmit into other markets, but I'll be watching for that. So it's not that I'm not worried. I think it's very appropriate to be highly vigilant, but I think it's also important to remind we've had an extended period of low volatility in the markets. That actually is not natural. I think having some more volatility is more typical. I think there's some mechanical things which we won't get into in the market which might have caused an unusual spike, but I think that's an example of an excess and imbalance that this type of event may cause us to examine and be much more vigilant about, and I think that could be healthy.
Mm-hmm. Part of the sort of market jitters that we've seen in the last couple of days seem to have been triggered by the higher than expected wage growth and the fears in the market that the Fed might raise faster than anticipated. Jens Weidmann was saying earlier that markets or central banks might find themselves in an echo chamber of their own making. Are markets too focused on central banks?
Well, in fairness, so let's just step back. The 10-year Treasury, which has backed up meaningfully over the last, from say in the 240s, 250s to in the 280s, we don't, so part of it may be expectations about central bank action. Part of it may be what I talked about earlier, strong growth in the United States and globally, a tight labor market, maybe a concern about overshooting. The history, for at least in the United States, of overshooting full employment is not a happy one. The ability to overshoot and overheat the employment market, then have a soft landing, has been challenging. So I think you may be seeing a little bit of that in the 10-year Treasury. Markets are watching that, maybe trying to adjust to it. That adjustment process doesn't occur overnight. Could take weeks, could take months. It's a natural process. It might lead to more volatility. And I think one of the reasons people ask me, why did you join the Fed? One of the reasons was, as difficult as the crisis was and all the actions that had to be taken, I think the period of quote unquote normalization that we're going through, I think will be just as challenging, require a lot of patience and real vigilance. And I think it'll take time. And I think that's why I'm here. I don't expect this to be easy, but I think we shouldn't underestimate this period that we've been going through and will go through is challenging to try to create more normalization in monetary policy, but it's something we're going to have to be very thoughtful about executing, and we're in that process.
So the Fed started to reduce its balance sheet last quarter of 2017. It's continuing at an increasing pace. So far, it seems to be going reasonably smoothly. What eventually in Europe, I think we'll hope to also reduce balance sheets here. What can we learn from the process as it's been done in the US?
So I'd say a few things about this. One is we spent many months planning and debating it. Second, we devised a plan. Again, for us, it's a little different than here. It's treasuries and mortgage-backed securities. So we devised a plan that would be very gradual and a relatively small percentage of the daily trading volumes. And we're not selling securities. We're simply not renewing them or buying new securities as they mature. And so I think one of the lessons, and I've said this before, and in this debate I've said this, sometimes slower is faster. In other words, I think some patience, which is not a quality as a business person, it was not one of my better qualities, but as a central banker, I think it's very important. I think it's very important to come up with a gradual plan, realizing even though you'd like to do this faster, sometimes going and more patient and making sure the markets and the world adjust to it, you will actually be able to do it more successfully. And I think that's part of the lesson. And so I think it's challenging here as President Weidmann just went through, more heterogeneity, different sovereign debt balances to buy, corporate debt. And so I think the main thing we've tried to do is just make sure, for me as a markets person, previous markets person, we're a small percentage of the daily volumes. It's done gradually, and it's well communicated for months in advance so people can adjust their portfolios or their asset allocation or whatever they need to do to know that this is coming and this is the plan. I think those are some of the lessons from this for me.
Since you mentioned people adjusting their portfolios, including treasuries, we've seen short-term treasuries going up in line with the gradual increases of the Fed funds rate over the last couple of months. However, long-term treasury yields have been relatively stable at around 2.8%. So the yield curve in the US has flattened quite a bit. In the past, the flatter yield curve has often been a harbinger of lower economic growth. Is this something we should look out for?
So that was true up until what you just said about 3 or 4 weeks ago, and then the curve got a little steeper.
A little.
Okay, so but I think that's a little bit what's catching people's attention is what's going on with the 10-year. So I'll speak for myself, and again, somebody's been watching this for a long time. Some flattening of the yield curve doesn't worry me in and of itself. I am not sanguine about the idea of an inverted yield curve, though, for lots of reasons. I think the good news is a Fed funds rate in the United States is 125 to 150. The 10-year Treasury today is in the 280s. We have quite a bit of operating room. And if the base case, for example, I mentioned for 2018 is 3, even if we wind up executing that plan, we still will have some steepness to our yield curve. So I think history has shown some flattening does not necessarily suggest a challenge. Inversion has been an uncanny, not 100%, but a high percentage of the time has been a forward predictor of recession. And I think the behavioral impacts of an inverted yield curve are something I'll be vigilant to. But we've got a lot of operating room here, I think, and I don't see that happening with our current plan.
So in preparing the further normalization of policy, or in conducting the further normalization of policy, what are the main indicators that you're going to be looking at? What are the main challenges you see ahead?
So I'm going to still be looking at first of all, our two mandates. I'm going to be looking at the full employment and where we stand on that. And obviously, as I said, I expect to see further tightening, but I'll be watching to see if that in fact happens. And then I'll be looking for progress in terms of our inflation mandate. And I've said to you, I think cyclical forces are building. I just expect progress. I expect progress, but I think it'll be slower and a little more muted and uneven because of the structural change that's going on, at least in the U.S. economy and to some extent globally. And also this global integration, globalization has an effect on that. And then for me, what I'll be watching very, very carefully is what kind of progress are we likely to make in the medium term on aging demographics, slowing workforce growth, productivity, and particularly, I'm going to spend a lot of time looking at and talking about educational attainment levels, middle skills training, because I think we can have an effect on trying to encourage more focus on that. And then I will be continuing to look at the third big structural factor, which is the trajectory and path of debt to GDP growth at the government level, which I believe is something that needs to be scrutinized.
Mm-hmm. In the last SEP, FOMC participants saw the longer run nominal Fed funds rate at or below 3%. With inflation at target, this implies a real funds rate of at most 1% in the longer run. So the sort of structural forces that you mentioned, you think they're behind this assessment of the longer run?
Well, this is the neutral rate issue. Yeah. So in the SEP, I'll speak for my own. What I've said publicly is I think the neutral rate is probably closer today to 2.5% and 2.75%, nominal, and so that is dramatically lower or meaningfully lower than we would have expected 5 years ago or 10 years ago or before. So why? And I think these drivers, for me, are having a muting effect on the neutral rate. So that affects. While I've said we should remove accommodation, the path is a little more flat than we would have seen historically because the neutral rate is lower. But I'm going to be. This is a theoretical judgment. It's not one of these things you turn on your computer screen and see they're quoting the neutral rate. And I'll be assessing and reassessing our judgments on that to see whether there's something changed that could help improve sustainable GDP growth in the United States, which I think ultimately is the biggest driver of the neutral rate. But so we'll be assessing, but that's my current judgment on the neutral rate.
Are you worried that you're going to be at the zero bound more often going forward because of the lower neutral rate?
I'll put it this way. I think it's important to take these structural drivers very seriously, to call them out. And also, as a central banker, I think it's important to realize and call out the limits of monetary policy and to encourage a broader array of economic policies beyond just monetary policy. And so I think we need regulatory review in the United States if it's thoughtfully done. Infrastructure spending, I think, could be positive. Corporate tax reform may have been an element of it, but I think we've got to worry about these other longer-term forces, which ultimately I think are going to dominate.
Mm-hmm. Jay Powell was sworn in as the new chairman of the Federal Reserve on Monday. How do you think the new leadership will affect the way policy is being discussed and carried out ultimately?
So I think Jay's a superb choice, and the good thing is he literally just moves one seat over around the table. We've been working with him closely. I've been working with him and with all the people around the table he's been working with for the last number of years. And so we know him well. He knows us well. I think he's outstanding. And I think that doesn't mean we shouldn't re-review, and I'm sure he will, how we do things, frameworks, targets, way we approach, how we operate. But I think he's an outstanding choice and is an outstanding leader.
Augustin Carstens was here in Frankfurt on Tuesday.
Yes.
He was pretty critical of privately issued digital currencies.
Right.
What's your thought on those? Do you see any financial stability risks?
And we work because we're in Texas. I spent a lot of time with Governor Carstens in his previous role and with the central bank. I think the only comment I'd make, listen, digital currencies and new forms of payment, blockchain, distributed ledgers, and so on, are here to stay. They're going to evolve. I'd be foolish to tell you I knew how they were going to evolve, and I think our job at the Fed, and I sit on a committee that oversees payments in the United States, I think our job is to work with the private sector and try to understand it, make sure there are guardrails for safety, soundness, and so on. I am mindful that on digital currencies, it's possible that one of the reasons for their growth has been anonymity. So we've done banks, regulators around the world have worked on anti-money laundering, know your customer. And obviously, digital currencies are a way for people to transact without knowing who you are. And so that's a caution that's worth paying attention to.
Mm-hmm. What are your thoughts on some central banks, let's say, thought experiments on issuing themselves blockchain-based digital currency?
I don't know is the answer. I think it's something I have to think about and consider more. I'm not certain about that. And I think it's something we're studying. I spent a lot of time on it. Spent a lot of time with private sector trying to understand it, and I think we'll have to be open to learning.
Mm-hmm. I think we're running out of time, but I wanted to leave some time, a couple of minutes at the end for questions from the audience. So, if you have any, please raise your hand.
Yeah, please.
Over here. Here. Third row, next to the...
Thank you very much. Sylvain Breuer from Natixis. Dear President Kaplan, you mentioned an aging demography as a factor to put a cap on the US growth. I was wondering whether you can add a few words on the effect of aging on inflation, and especially through wages, because it seems to me that we have a fastly rising share of workers above 50 in the US, which coincide with the cap on wage growth in the US. Right. So maybe.
So this is an example you're pointing out. So we've done a lot of work at the Fed and the San Francisco Fed in particular on the compositional effects where younger people are taking the place of older people in the workforce, and it may be having some effect on wage growth. And this is why it's a good example where aggregate data is useful, but I think it pays to especially when it comes to wages and prices and inflation, I think we need to disaggregate the data because we see different counter trends going on depending on educational attainment and different kinds of cohorts, and I think this is one example of it.
Over there, to the left, here, first row.
How you doing on time?
Thank you.
We're going.
Rob, nice to see you again.
Good to see you.
Sean Egan,
Yes,
Jones
of course.
Ratings. Could you comment on the $49 trillion of unfunded entitlements
Right.
coupled with the increasing dependency
Sure.
ratio and how we deal with that over time?
It's a bad combination. So as I like
That's
to
why I asked the question.
Yeah, I know. And this gentleman's at one of the agencies that analyze this. So when I was growing up in my career, let's say workers were here, dependents were here, and now it's moving where workers are here and dependents are here. So it means that naturally you're getting more leveraged, and there are fewer workers, and this is why workforce growth is essential. And states in the United States are finding this out in that I mentioned population growth and aging in the United States is an issue. If you look at a heat map, which I do every month, of which states in the United States are gaining population and which are losing, you can see why there's a whole number of states in the US that are under fiscal pressure for their future obligations because they're losing population. So I guess the point is, I would like to see us talk a lot more in the US about demographics and about the need for population and workforce growth. I don't think we talk about it enough.
Maybe over there in the first row. And please briefly introduce yourself. I forgot to mention.
Thank you, Mr. Kaplan, for your very interesting statement. I enjoyed it very much. So I have only two short remarks to your very interesting outcome of your results. The first is when looking at the side effects of the tax reform, are you worried with the reemergence of, let's say, the twin deficits that has played a lot of role in the past of your country, and what could that mean for the international environment? And the second issue, I would say, when looking at the similarities and differences in Europe and in the US, a lot of commentators talk about the income distribution and wealth distribution. Is it a matter you are worried about, and when you conduct your policy, and to be a little bit more provocative, do you also see an active monetary policy role in the overall income distribution figures? Thank you.
So I'll do this very quickly because I know we're pressed for time. I would say I'll start with the second one first, which is I think technology-enabled disruption and structural changes in economies, which are different in different continents, but they're really accelerating, for example, in the United States. I see it industry by industry, is affecting the workforce differently. If you've got a college education or you're highly educated, I think while this may be challenging, you can adapt to this. If, on the other hand, you have lower levels of educational attainment, I think this is having a much more challenging impact. And when I say unless you get retrained, it's not easy in your mid-40s to have your job be eliminated and tell you should go start over again and get retrained. But I think we're going to have to really take a hard look at this issue of math, reading, science, because we have lagged in the US. We need to improve. That would help adaptability. Middle skills training would help adaptability. We're not adaptable enough, and that's an issue. On this issue, the only comment I'd make, probably nothing new on the fiscal situation. I'm concerned where most of my lifetime we've used increasing debt to GDP as a way to stimulate growth. I just think we're getting to the stage in our evolution where there are limits to our ability to do that, and we have to start moderating, particularly in light of demographics, and I think we're going to have to face that.
I think we have time for one more question, gentlemen, in the fourth row. Yes, yeah.
Thank you. Alan Brenner from University College London. The US government-sponsored enterprises, Fannie Mae, Freddie Mac, have been described as being as if they were part of a communist 5-year plan. There is, as you know, a close relationship between the funding of the GSEs and the Fed's balance sheet. And I was wondering what you think the future will be in terms of the GSEs and their future funding.
So I'll just say I actually done a lot of work on this in my previous life, and I've written a case on it, and I spent about a year with Freddie. In this job, though, I think the most appropriate thing is probably for me not to comment very extensively. I think it might be viewed as overstepping our bounds, but I think it is something that is going to have to be dealt with.
With that, thank you, Ralph, for sharing with us.